Good afternoon. I'm Karl Kaiser. I am director of the program on transatlantic relations of the Weatherhead Center for International Affairs. I'm representing today our acting director, Jeff Frieden, who, due to an eye operation, couldn't come, but the operation went very well, so he's very well. Today's lecture is a Warren and Anita Manshel lecture, and it is a lecture series that has been created by the Manshel family to bring speakers here to address issues of American foreign policy. But today's lecture is also a lecture in the tradition and in the spirit of another series that the Weatherhead Center organizes, the Paul-Henri Spaak lecture, which brings Europeans of prominence to the Harvard campus. The last Europeans to come here were José Manuel Barroso, the Commission President of the European Union, and the High Representative for Foreign and Security Policy, Baroness Ashton. Important Europeans. And the speaker of today, Jean-Claude Trichet, is a great European. Many of us have been, during the last years, been bombarded by negative predictions about the future of the European Union. For years, we have heard about the pending collapse of the euro, and that kind of spirit is very well summed up, for example, in this issue of the time, which says, the decline and fall of Europe, and maybe the West. And it says, the end of Europe, its economic union is unraveling, London is ablaze, and the continent's once dependable trading partner, the US, is too feeble to save the day or the euro. Say goodbye to the old order. Well, this kind of spirit has dominated very much the English-speaking press. But as we all know, during the financial crisis, which started in 2008, there was one European institution which did the right thing. That was the European Central Bank. And during those critical years, it was headed by Jean-Claude Trichet. And as a result, the euro is still there and is doing well. And we owe, and Europe and the world owes a great deal to Jean-Claude Trichet, who steered the European Central Bank and the euro through these critical years as the second president of the European Central Bank. He has received many awards, and he has received the award, perhaps the most important award that Europeans give to personalities that have great merit in uniting Europe. That is the Charlemagne Prize of Aachen. He received that a little while ago. Jean-Claude Trichet hails from Lyon. He attended the École Nationale d'Administration and the École Nationale Supérieure des Mines, and Sciences Po in Paris. He was advisor to the French president, to the finance minister. He chaired the European Monetary Committee before he became governor of the Banque of France. And from there, he became the president of the European Central Bank for 8 years until Mario Draghi replaced him. Jean-Claude Trichet is today the chair of the group of 30 bank governors of the world. He is a member of the Institut de France, and he chairs the European group of the Trilateral Commission, and I could mention a number of other functions, but I'll stop here. He will speak to us about the state of the euro and its implications for relations between Europe and the United States. Jean-Claude, the floor is yours. Thank you.
Thank you.
There we go.
Thank you.
Is it on
very
green?
Much. Let me put it right. Yeah.
On. There we go.
Here we are. Thank you very much for your very nice introduction, Karl. I have to say I'm so happy to be here in front of you in Harvard. It's always a great privilege to be here in this sanctuary of thoughts and thinking and excellence. I would like to pursue what you said in the introduction, only to give a measure of the extraordinary difference between the ex-ante prediction on the euro as a currency and on the euro area as an entity, a single market with a single currency. To illustrate that, the best would be to suggest the Banque experiment. We are at the end of the first quarter of 2008. We are in Harvard, and I am starting an exposition on the euro in the making. So I will tell you the euro will be set up the 1st January 99 in 9 months' time. In Harvard, I think that perhaps half of the audience would have trusted me. In New York, only, I would say 10% of the audience would have said, yes, it's very likely that they would set up the euro in time, as they have said, 1st January 99. But again, Harvard is more enlightened by definition.
Of course.
Then I would say this currency will keep its value in Europe. The price stability will be delivered very well in line with the definition of price stability that we have, which is now, by the way, the universal definition of price stability, namely 2%, below 2%, very close to 2%. Then I guess that nobody would have trusted me because it was much too bold, a currency starting from scratch. How can you be bold enough to suggest that it will keep over 15 years its value that well? Then I will go on and I will say in 14 years and a half, you will have 335 million people, more than the United States of America, sharing that currency. Then I let you guess how many people would have thought that it was credible that this new currency, starting absolutely from scratch, would have 335 million people sharing that currency. And I would say then in 15 years' time, there would be 18 countries, 18 sovereign countries having that currency. No, I let you continue to compute. Then I would go on. And I would say the currency will keep its value in terms of price stability better than the best currencies before the euro. And I'm speaking in front of a Bundesbank man. And then absolutely nobody would have trusted that it was even thinkable. And then I would go on, and I would say, you know, the value of that currency vis-à-vis the US dollar would be higher after 15 years than the entry level. The entry level was, by the way, 1.17. But the Banque experiment is at the end of the first quarter 98, so we didn't know yet what would be exactly the entry value. But I would say that. Then in New York, 0% would trust me, and I'm very generous with Harvard in saying that perhaps 2% of the audience would have said, after all. And then I would lose the last 2% of Harvard in saying, and that would happen after 5 years of the worst crisis since World War II, which, by the way, as we know, could have been the worst crisis since World War I. At least it is my own theory, and I could respond to questions on that. All what I say is true. All what I say is the reality that we have in front of us, the facts, the figures, the reality. Now I will go on to be even more incredible in my prediction. And I would say that we would have the start of the worst crisis ever since World War II or World War I in the 15th of September 2008. And I would say this would be a terrible crisis, of course. You would have, at the moment of this crisis, so 5 years ago, 15 countries member of the euro area. And as you suggested, Carl, of course, everybody since then was guessing at which moment the euro area will explode, at which moment you would see country X, country A, country B, country C, and so forth, leaving the euro area. But I will give you a scoop, which is a vertiginous scoop, obviously. Since Lehman Brothers, 3 new countries have entered or will enter the euro area. Slovakia was not member of the euro area at the moment of Lehman Brothers and is now in the euro area. Estonia was not and is now. And you know that Latvia will enter in 2 months' time at the very beginning of January. So we were 15 and we will be 18. So I stop there. Only to echo what you said. We are plunged in a universe where there is obviously a bias. And I don't say, of course, that everything is okay in Europe. I will, on the contrary, elaborate on all the weaknesses of the European in general and of, in particular, the euro area. And there are a lot, and I will list them. So I don't think we have to be complacent in any respect. And I fully understand why when you start an endeavor which has never been started but never been tried in human history, skepticism is, after all, a very good way of looking at things. So it's normal that when you are that bold, you are surrounded by appropriate skepticism. After all, it's also the right way to tell you permanently what you're trying is extremely bold, what your endeavor, your historical endeavor is extremely bold, and you have to be permanently cautious, and complacency would be the last thing to embark on. On the other hand, it doesn't help too much to be surrounded by an environment which is that negative, and particularly, of course, a financial environment which is that negative when resilience is at stake. And I think I give you some examples of a remarkable resilience, particularly as regards the currency. You have to understand that the euro is the emblematic illustration of the European endeavor. So you have a lot of rhetoric on the euro is in great danger, we have to save the euro, what will happen to the euro, and so forth. But during all the crisis, the euro was never put into question, as I already said. And the credibility, the creditworthiness of the euro was never put into question. And we didn't have to wait that the US would threaten the rest of the world to default for the euro to be credible. No, the euro was credible since the very beginning of Lehman Brothers, and there was absolutely no point in teasing the euro as a currency. As regards the euro area, it is another story. So I think I said sufficiently eloquently, if I may, that the euro as a currency was very solid, credible, and I have to say that this credibility, which is obvious when you look at the past, and it is what I have done a moment ago, is also there as regards the future. When you look at the inflation expectations over the next 5 years or the next 10 years, you see that we are credited of the same quality, if I may, in terms of solidity, in terms of capacity to preserve the value, as we have demonstrated in the past. There is no problem there. And on the exchange market, as you know, the currency is considered also to be credible in the future as it has been in the past. So I would like to concentrate on the euro area itself. And the euro area itself as a very important issue for the Europeans, and also a very important issue for the rest of the world, and in particular for the United States of America, because your grid is to look at the rest of the world through the eyes of the United States of America. This entity, this single market with a single currency, is a very, very important partner of the United States of America, not only in terms of currency. We are the 2 major currencies of the world in the international monetary system, in terms of trade, the euro area is an extremely important power as regards trade. As you know, trade is run in Europe not at the level of the euro area, not at the level of the 18, but at the level of the 28 countries member of the European Union. But you know that we are, as European, an entity which has a bigger trade and therefore a bigger trade influence in the rest of the world than the United States itself. So it's a very, very important issue for the US to see what is exactly the solidity, the credibility of that entity which is in front of the United States of America. And the fact is that despite all what I was saying to demonstrate that there was a bias vis-à-vis the European and vis-à-vis the euro area in particular, but it is absolutely true that the euro area has been, still is, the epicenter of what I would call the third episode of the crisis. And now I go, if you permit me, for some minutes on the description of what we have experienced since 6 years, say since the eruption of the crisis of the subprime. I propose to you to read what has happened as a sequence of 3 episodes. First episode, the financial turbulences that are triggered by the subprime crisis. Then for the central banks all over the world, it starts in August 2007 with major dislocation of the money market. But of course, we had before a number of phenomena that were clearly demonstrating that there was a big issue with the subprime market, which was the most vulnerable of the financial markets of the time, and which was more or less disturbing and triggering a lot of abnormal phenomena. But there was the first acute episode with this impact on the money market and the fact that liquidity evaporated from the money market. We had to intervene. We were the first, by the way, the first central bank to intervene with non-standard measures on the money market was the European Central Bank, the 9th of August 2007, when we supplied 95 billion euros of liquidity because we had decided to supply liquidity on an unlimited basis, full allotment, fixed rate, to be sure that we would keep the control of our money market at a time where it was totally dislocated. So that was the start of the first episode. I would call that episode financial turbulences. In all major markets of the advanced economy, you had abnormal volatility, spreads that were much higher than before, risk premia much higher than before. It lasted from August 2007 up to September 2008. Then you had the second episode of the crisis, which was Lehman Brothers. The bankruptcy of Lehman Brothers was a single event for a medium-sized investment bank in New York, but it triggered the start of the collapse of the global financial system, at least the part of the global financial system which was in the advanced economy. And I would call this second episode of the crisis the grave and immediate threat of collapse of the financial system, with a lot of consequences had we let the collapse of the financial system operate, had we not, we central banks, and had they not, the executive branches of the advanced economy, not taken extremely bold, extremely swift measures in order to avoid that generalized collapse. For those who have experienced this period, namely for Ben, for myself, for the governor of England, of the Central Bank of England, or Japan, and the other friends that were not at the epicenter of the crisis, but were in the emerging world, it was really a case where you could say that the metaphor of the house of cards would have been appropriate. You could really see that you had taken out Lehman Brothers. It was one card, but the rest of the house was about to collapse. Grave and immediate threat of collapse of the financial system. As you see, I am concentrating, because it was what had happened, on the advanced economy. And in a recent lecture, I call this crisis that we have in front of us the advanced economy crisis, AEC. You had the Latin America crisis, you had the Asian crisis, not to speak of other crises in the Middle East or in Eastern and also in Soviet Union. But there, clearly, we, advanced economy, have to cope with a crisis of our own, and which, by the way, has a lot of consequence, because we remain the most important countries in the world, the most important economies in the world, the most influential economy in the world. And of course, a Latin America crisis of the 80s or an advanced economy crisis of the 2000 and 2010 is something of a very different nature. But nevertheless, there is really a place in the world where you can say they are in crisis. And it was not the emerging world, it was the advanced economy. It is still the advanced economy. So I'm back to my second episode of the crisis. We have, as I said, swift and very bold measures taken by central banks. By the way, they are still there, so it's not necessary to elaborate on a lot. Outright purchases of tradable securities in the US, in Japan it had started before, in the UK, unlimited supply of liquidity at fixed rate in Europe, some purchase also of securities. But all this is really very unconventional, was not experienced before in the US or in Europe or in the UK, even if Japan, for other reasons, was a little bit in advance, sadly so, in this domain. And the governments themselves had to step in and to take enormous risks that are still reproached to government by our democracies. But all that being said, after 3 quarters of dramatic free fall of the real economy in the advanced economy countries, we have the sentiment. So after the last quarter of 2008, the first and the second quarter of 2009, that we are really stabilizing at a very low level in terms of real economy, and that the derivatives, say, of growth are becoming again slightly positive. And so that we are progressively out of this great recession. We avoided the Great Depression, and I really trust that had central banks not embarked into very bold measures, and had government not being able to do the top and all what you know, which, as I said, was very bold and is not necessarily easy to be accepted by our people in all advanced economy, then we were starting to see that we are getting progressively out of this drama. And then starts the third episode of the crisis, which is the crisis of the sovereign risk. The moment when the crisis muted from second episode to the third, I can sum it up in the best fashion possible with a dialogue with Ben. We were in Basel, and Ben put his finger on me, and he was saying, Jean-Claude, now it's your turn. And he was signaling that after having been at the epicenter of the 2 first episodes of the crisis, subprime, United States of America, New York, Lehman Brothers, United States of America, New York, the epicenter of the crisis had crossed the Atlantic and had hit the euro area, Europe, say, and the euro area. And it was absolutely true. We were and we are at the epicenter of the third episode of the crisis since then. I would say, despite all the efforts of the United States of America, recent efforts to say, we could also be at the epicenter of the crisis of the sovereign risk. We can pretty well default, don't underestimate what we can do. But But it was, as we all know, quite artificial, obviously, and very fortunately so, I have to say. Still, there is something which is serious there. Namely, markets, investors, savers, the world over are not taking now any signature for granted. The creditworthiness has to be demonstrated. And we had some examples before this drama that we are experiencing, and which is over, fortunately. You remember that there had been downgrading by some rating agencies, that you had also some very eloquent investors saying, I don't invest anymore in US Treasury because I'm not sure that they will run things correctly and so forth. This demonstrates, in my opinion, that I am right in saying that we are at the epicenter of the sovereign risk crisis, but that the sovereign risk crisis is there, and that all advanced economies have real problems. Japan, the United States of America, even if they are overblown, and the UK too, because as you know, the UK has changed drastically its policy precisely to prevent the fiscal policies to be dangerous for the country. So you see my own analysis. Third episode, the mutation of the crisis becomes a crisis of the public sector, a crisis of the sovereign risk, after having been a crisis of the private signature. And we are the epicenter. So the question is, why are you the epicenter of the third episode of the crisis? What happened in the euro area that makes you precisely with the worst, I would say, countries from the standpoint of creditworthiness, seen from the rest of the world, seen from the investors and savers in Europe, in the US, in the rest of the world? And I would propose to you, and you see that I'm not complacent at all, 6 reasons why the epicenter of that episode of the crisis is in the euro area. First reason, we had, when we started the euro area, a fiscal framework, which was a very important one, called Stability and Growth Pact. I have to say that, very sadly, that the central banks of all nations in Europe and the ECB, and myself as president of the ECB, I had to fight the big countries in the euro area, telling everybody, not for us. We do not want the Stability and Growth Pact to apply to us, and particularly when you are speaking of possible sanctions. And I have to say, sadly, that Germany, France, Italy were 3 countries in particular that were claiming that they didn't want to apply the Stability and Growth Pact. We have no federal budget. We have no political federation. We have a single currency. From the very beginning, we had said the quid pro quo is that we must have a correct, I would say, implementation of our own fiscal framework and surveillance being exerted by the Commission and by the other countries. In our jargon, it is the Council, the other governments, that would take care for these fiscal policies to remain sound and healthy. But again, this Stability and Growth Pact was demolished, not entirely in its letter, but certainly in its spirit by the big countries. That's the first reason for the weakness of some countries in the euro area. Second reason, we had, since the very beginning, we had no surveillance of the competitive indicators. And I have to say that after some years, we could see clearly in the central banks and in the ECB Governing Council that the divergence between the competitive indicators, in particular the unit labor cost, but other indicators in a single currency area, were not sustainable. And I was circulating myself documents every month. I still have these documents with me every month since 2005 to tell the governments of Europe, be careful, you are in a single currency area. If nominal evolutions of revenue, cost, national, if I may, nominal evolution homothetically are growing much faster than in the euro area, as a whole, you are losing competitiveness. If it goes below the average, you are regaining competitiveness. So check whether you were over-competitive and you can lose a little bit competitiveness, or whether you were under-competitive and you can gain competitiveness. But be careful. It is extremely dangerous to play with the nominal evolution of your revenue, cost, national inflation in a universe of single currency. But benign neglect was practiced. And the governments waited for the crisis to erupt before looking at it seriously. Second reason. Third reason, the two first reasons are not forgivable easily. It's terrible not to apply the rule, or not to apply by the rules that were obvious since the very beginning. It is really a pity that you do not discover that you have phenomenon of divergences that are not sustainable in the euro area. The other reasons are perhaps, the two successive reasons, the third and the fourth, are more explainable. We had no experience of a dramatic crisis of that type, so there was no financial tools to respond immediately to the crisis. We had to invent a mechanism of stability, the European Stability Mechanism, in order to be able to do that. But to invent in Europe means not to activate federal institutions which do not exist in this domain, but to go through the 17 democracies of the time in order to get authorization to have this new entity, which is the crisis management tool, that financial crisis management tool that was necessary. So we had to go through a very painful exercise, and this did not simplify the crisis management of the European. Then we have a last reason, which also can be explainable. We had no banking union. And again, it was a byproduct of the crisis to realize that the creditworthiness of the state and the creditworthiness of the banks were very closely linked, correlated, because the state was the backstop of the bank. And it was the case in the UK, it was the case in the US, it was the case all over the advanced economy. But in Europe, in the euro area, it introduced some kind of virtuous circle and vicious circle inside the euro area, because you had enormous differences between the creditworthiness of the public entity, of the treasuries, and having this kind of extreme difference between the creditworthiness of the various countries. It created, again, an adverse feedback loop, or a positive feedback loop, with the creditworthiness of the banks. And the fact that we would need some kind of banking union appeared in the crisis. That was my fourth reason. I said six. So there are two last reasons that are, I would say, not only reason why the European of the euro area were the epicenter of the crisis, but why European Union as a whole has weaknesses that are shared, of course, by the part of those members of the European Union that have a single currency. It is the fact that we did not achieve the single market, which is, again, an endeavor at the level of the 28, and we did not implement correctly these famous structural reforms that are also an endeavor which is pursued at the level of the 28 and is particularly hitting, if I may, together with the unachievement of the single market, because in a single market with a single currency, you need even more to have an economy, a single economy that is as flexible as possible, has achieved as much as possible the single market, is as flexible through structural reforms as possible, in order for the, I would say, the competitive channel to function as well as possible. In particular, the remark I was making on the fact that the divergences of competitiveness could be very dangerous, have been very dangerous, comes out of the fact that there is no automatic correction of this loss of competitiveness, which would be much more the case had we had achieved these two last, I would say, endeavors at the level of the 28. So 6 reasons. So we can explain why we were in this clumsy situation. As you know, it did not explode. We didn't have country A and country B leaving, or country A, B, and C leaving. And so let's try to understand why. Why the resilience of the euro area has been much superior to what was foreseen, projected, and it's very important seen from the United States because, again, it is a stabilization of the euro area, so a stabilization of Europe as a whole, of the main partner amongst the advanced economy, and it is, of course, something which is as important that we were able to cope with this dramatic situation as was important for us that the US was able to cope with Lehman Brothers, to cope with the problems that were emerging after Lehman Brothers, and embark in the top measures and be able to correct, I would say, this dramatic contagion. By the way, it was not easy in the US. You might remember that the top was refused by the Congress in the first place. And then there was a new meditation by the political elite in the US. The Dow Jones was falling like a stone. And in a second try, the top measures were accepted. But it was, again, a close call when you see exactly how the US democracy has functioned at the time. I see you will say that your rhetoric is too simple. You have 6 reasons there, you have 4 reasons there, you have 3 episodes there. I give you 4 reasons why it seems to me we can explain that the tail risk, the materialization of the tail risk of a dramatic change in the composition of the euro area has been considerably alleviated. First, the countries that were under stress by the markets, namely in the order of the stress that they had to cope with, Greece, Ireland, Portugal, Spain, and Italy, those 5 countries, embarked on adjustment. And since the very beginning, of course, of their problems, so since 2010 for the 3 small countries, and since 11 for the 2 bigger countries, a lot of hard work has been done, really a lot. And to give you only one example, the current account deficit of those 5 countries in 98, 99 was around 8% of the GDP. So very big current account deficit. At the moment I'm speaking, the consolidated current account deficit is less than 1%. And when we will recompute everything over the last 12 months, perhaps close to 0. So you see, first reason for the stabilization, for the absence of materialization of the tail risk and the risk itself being considerably alleviated, adjustment, a real adjustment is operating. And everybody knows, of course, that there is a price to be paid for that, that you had a compression of domestic demand that had been very, very high, that the price has been much too high, I have to say, in many respects, in terms of youth unemployment and so forth and so forth. But the fact are there, adjustment is operating. A second reason, which is very important, in my opinion, is that the 6 weaknesses I had listed are being treated. The Stability and Growth Pact has been reinforced. You had a fiscal compact, which is some kind of new treaty, which has been signed by 25 countries, and not only by the country member of the euro area, but it gives a lot of teeth to the Stability and Growth Pact. And so the first cause, the first reason why we were the epicenter of the crisis has been, again, treated seriously, at least treated seriously in terms of new legislation, if I may. Then we have also treated the second problem, absence of surveillance of competitive indicators. We have now an acronym, which is the Macroeconomic Imbalance Procedure, MIP, which is, in my view, as important as SGP. So you have SGP, Stability and Growth Pact, MIP, Macroeconomic Imbalances Procedure. And this is supposed to look to call the Commission to monitor the competitive indicators and the imbalances, domestic and external, in particular the current account imbalances. So the second reason also has been treated. The number 3 and number 4 have also been treated, as you know. Still, of course, it is work in progress because the banking union is work in progress. We have a single supervisory authority, which will be very close to the central bank. We do not have yet a single resolution authority or a single resolution mechanism or a single resolution fund. And I trust that it is very important. So that's work in progress. Of course, there are a lot of political difficulties, as you can expect from our democracies when embarking on something which is as bold as an achieved banking union. But nevertheless, the work has started. As regards the crisis management tool, I already said that we had gone through the 17 democracies to create this mechanism for stabilization, which called for a new treaty. So we had a new treaty to permit to have the capacity of handling a mechanism of stabilization. Of course, it's complex, it's difficult, you can say it's not enough, and so forth. But you see that the second reason why we have proved resilience and proved, again, that we are more solid than was suspected is because we really improved economic and fiscal governance. I mentioned, for memory, the fact that we have also reiterated structural reforms endeavor and the achievement of the single market, which are at the level of the 28. This was less, I would say, directly the responsibility of the single market with a single currency. So this is, for me, the second reason. Then you have a third reason, which is extremely important. Each time our democracies were asked whether a country wanted to stay or to quit, or whether another country wanted to expel some members of the euro area, the response was, we want to stay and we don't want to expel other countries. And I will mention only because these are two countries and two parliaments and two people that are very important, both as representative, those who could decide to leave. Greece is a case in point. And they said, no, we want to stay in the euro area, whatever the difficulty and whatever the problems, particularly as regards, as you remember, the fact that we cannot repay our private sector credit. And Germany is a case in point, but not the only country, but a case in point as regards the countries that decided to help after appropriate meditation in their democracy and decided not to expel other countries. And then you had a last reason, which is also very important. It is the central bank itself. The central bank said each time there was very, very acute tensions for the central bank, it created a very, very grave problem for the single central bank of a group of countries, that its own monetary policy could not be conveyed correctly in country X, country Y, country Z, because the benchmark, the treasuries in that particular country had an immense spread in comparison with the core of the single currency area. And then, of course, for the central bank, it meant that the monetary policy could not be transmitted. So in my time when I was president, we decided twice to intervene in order to help restore a better transmission of monetary policy. It was our responsibility. If the countries would have said, we leave the euro area, then we would have no responsibility, of course. If the other country would have said, we expel country X or country Y from the euro area, we wouldn't have responsibility. It's not our job. But as long as we had countries that were in the euro area, it was appropriate for us to reflect on how to transmit our monetary policy. But it was futile to have this meditation without the help of the countries themselves, because we would have tried and we would have been sure not to succeed, of course, by definition, because the appropriate adjustment would have not started. And I mention only that I had to write down myself the messages for two prime ministers of two of the big countries in Europe at a moment where we were in a very, very difficult situation. We could not transmit correctly our monetary policy to around 40% of the GDP, a little less than 40% of the GDP of the euro area. And it was our duty, even if it is quite extraordinary, to send very strong messages to governments in telling them you have to make a U-turn, because otherwise we cannot help restore a better transmission of the monetary policy. And by the way, there was such U-turn in those countries with a lot of course, appropriate meditation, new parliament meetings, and so forth. I don't want to embark too much. And by the way, we didn't want to enter in a qui pro quo, a complex qui pro quo. We said our own vision, our own understanding of the situation is that if you don't do this, this, and that, you will not convince investors and savers the world over that you are credible, and then it will, of course, create a lot of problems. But we reserve our judgment, and we judged that what had been done and proved was sufficiently credible to permit that it was a case to help restore a better transmission of our monetary policy. And the last time this was done was in mid-2012, and particularly in September 2012, where it was said very clearly, if a country is in difficulty, if it asks to be helped by the rest of the European, by the other countries, if the other countries say, okay, we go and we support this adjustment program, then the central bank can intervene. And as you know, this was, in my opinion, a very, very important element to stabilize the situation. It was not activated, but the fact that it exists being credible because the bank had already intervened in this treasury market. And it was conditioned, as you see, by the activation of a mechanism inside the governments themselves. So we could alleviate considerably the risk of change in the composition of the euro area. And now, if you permit me, I would like to perhaps to conclude, because you very generously gave me 45 minutes. I understand it is because we have questions, and I would say we obviously proved capacity to be resilient. That, as I said in the introduction, has been quite remarkable, obviously, and of course was largely unexpected by a large number of observers. There is something which I feel very profoundly myself, because I was one of the negotiators of the Maastricht Treaty. I could see the way the various countries were behaving over a long period of time. And what is very often missed by the rest of the world, and in particular by the United States of America observers, I don't speak of the government, which I found always extremely responsible and extremely, I would say, fair in all our relationship. But I'm speaking more perhaps of some players, private sector, financial institutions, highly leveraged and so forth, that missed something, which was the underlying historical endeavor. I mean, we are coming from speeches, or one speech in particular that was delivered 63 years ago, and we have 63 new years ago to proceed and to advance. And nobody 63 years ago would have imagined that one day in Harvard somebody could say all what I said in introduction as regards the single market and the single currency and the euro area. So it's a historical process, and there is something underlying which is difficult to understand when you are not in, when you are out. And then let me, as a conclusion, elaborate a little bit on what I see as the next step of this historical process. Because obviously what has been done under the stress of the crisis and with the observation that a single market with a single currency of 335 million people was calling for improvements, all this has reinforced considerably the political union in economic and fiscal domains. A de facto political union. When you enter into the details of your fiscal policy, as is done now by the Commission and by the other countries, when you have this level of coordination and of surveillance, you are at the heart of political union, because democracy started, and I mean the United States, no taxation without representation. That's the start of the democracy. That's the start also of the independence of the US. But it is the way we started the political democracy. And there, we, as I said, we went very far because it was obvious, it was the situation which was commanding that. So we have to reflect on the democratic accountability of this political union, de facto political union that we have at the heart of our countries and of our economies. And one of the avenue I would suggest would certainly be to go as far as possible in the direction of giving more responsibility to the European Parliament. They are elected by the people of Europe, so the legitimacy of the MPs is there. They are members of the Parliament elected by our fellow citizens. I don't suggest that it solves all problems, because we can see in the United States that the Congress has not a very good press at the present moment, so it doesn't solve all problems, but at least it is unquestionable in a democracy that you are an institution which is elected by the people, by the sovereign in our democracies. And so I have floated some ideas that could permit to introduce more democratic accountability in our procedure. I give you only one example, because one can reflect in many, many directions and dimensions, but only one example, which would be that if country X says what you are recommending, you Commission, in terms of, I don't know, freezing spendings in such and such sectors, and in augmenting VAT as a general rule, in order to be sure that we have a sustainable fiscal policy. And of course, the argument of the other countries would be, because we not only we trust that it is good for you, but we trust that it is good for us, because otherwise you would start again a destabilization of the whole, and we cannot tolerate the destabilization of the whole. But say that the country refuses, then the idea would be, then it could ask for an arbitrage of the European Parliament. Of course, with the gathering of those MPs that are members of the euro area. And then the European Parliament, as a democratic entity with a responsibility for the euro area as a whole, and considering that if a country behaves extremely improperly, it creates a problem for the euro area as a whole, then the European Parliament could decide and say, well, we consider that you have to do this and that. Of course, it would call for a change of the treaty, because what I call for would be that once the arbitrage is made, it is immediately implementable in the country concerned. So I wanted to give you that example of possible avenues which would not transform overnight Europe and the euro area as a United States of Europe. Clearly, we are in a different universe. Germany is not Texas. France is not California. We are in a very different setting of culture, and Austria is not Delaware. So we are in a different universe. But I trust really that we cannot consider that we can stop our own, I would say, march at the present level, because again, I think we are really at the moment where democratic accountability becomes something which is absolutely essential. And it seems to me that it is profoundly resented by the people of Europe. So I want to stop there. Thank you very much for your attention, and be ready for questions.
Madame Trichet.